Thank you, Bob, for asking me and giving me the privilege and honor of introducing our speaker. In your remarks, one operative word is old. I am old, a friend of Raghu's, but I'm old enough to have known Art Okun personally while Brainerd and I were graduate students here at the Yale Economics Department. And in fact, I still remember watching the Kennedy-Nixon debates at the television. We didn't have television at Okun's, Sue Okun and Art Okun's house. Anyway, let me turn to our speaker. Again, I was tempted to start with the conventional sentence. Our speaker needs no introduction, and then go on for an hour introducing the speaker. I won't do that. I will be brief. Raghuram Rajan, Raghu, as he is widely known, is a world-acclaimed scholar of the theory, empirics, and practice of domestic and international finance. Raghu is the Eric Gleischer Distinguished Service Professor of Finance at the Booth School of Business at Chicago. He got his PhD from MIT with a dissertation on banking. And he did his undergraduate work and got a degree in engineering, bachelor's degree in engineering, and a gold medal from the well-known Indian Institute of Technology at Delhi. He followed it up with another well-known management institute in India, the Indian Institute of Management at Ahmedabad, with an MBA degree before going to MIT. Raghu served as the chief economist of the International Monetary Fund during 2003 to 2006. And from this position in 2005, he warned the world of the looming financial crisis 2 years before the crisis hit the world. He pushed the IMF to shift its emphasis of its research from macroeconomics and policy towards financial sector issues. Of course, Raghu's warning apparently fell on the deaf ears. The dominant members of the IMF, such as the US and EU, traditionally ignore whatever IMF says or whatever IMF advises them under the annual consultation with the IMF under Article 4. Even though the leading agents of the financial crisis paid no attention, and I hope Raghu will enlighten us as to whether this time, he is now writing even more about the financial crisis, this time they will hear him better than they did earlier. Raghu is on the Indian Prime Minister's Economic Advisory Council and serves on the Board of Comptroller General of the United States. I was privileged to join him in visiting India's central bank, namely Reserve Bank of India, and writing a report for its governor, assessing the bank's research output and capacity and suggesting ways to strengthen the latter. Raghu's contributions have been recognized with many awards, including election as President-elect of the American Finance Association, Fellowship of the American Academy of Arts and Sciences, Fisher-Black Prize of the American Finance Association for a person under 40, Jensen Prize, Pharma DFA Prize, and the Brattle Prize thrice for distinguished papers in that journal. His widely read book with Louis Zingales on saving capitalism from the capitalists has raised expectations about his eagerly awaited book due this June, entitled Fault Lines: How Hidden Fractures Still Threaten the World Economy. His CV is long and impressive, and he has co-authored with many people. A few probably influenced, a few of his papers probably influenced by his co-authors, regrettably engage in cross-country regressions. But then nobody is perfect. Here is Raghu.
Thank you, Dean. Thank you, Tian. Well, it's a great pleasure to be here at Yale University, and I was going around campus with my daughter this morning. She's certainly interested in universities, and it was a delightful experience seeing what a wonderful campus and university you have. And it is a particular sort of privilege to be here with friends such as T.N. and Bob Schiller, talk about an issue which I think is going to be with us for many years. I think the question that I want to ask is whether the crisis that hit us is over. And by that, I don't mean just the narrow features of the crisis. Are we going to get a second dip? Are we going to get a third dip? What's going to happen to commercial real estate? What's going to happen to sovereign defaults? I want to talk about the deeper underpinnings of this crisis. Why did we have this crisis? Was it the first of the crises driven by the underlying forces I'm going to talk about? Is it going to be the last? And if we really want to address it, what are the things that we need to do? And I'm going to start by saying that first, I'll talk a little bit about, is this phase of the crisis really over? But then I want to move on quickly to arguing that this was not the first crisis that was caused by the underlying forces. This was just the latest and perhaps the most dramatic and devastating. And that until we fix the underlying forces, it is quite possible we have future recurrences of what happened, different forms in different areas of the world, but it is something that we need to tackle. That's where I'm going. Let me start first with just defining it. And as I said, by it I don't just mean narrowly this crisis. But in this crisis, clearly there is some way to go. Commercial real estate defaults are increasing. Increasingly, the enormous fiscal deficits that have been created partly by government intervention, partly by the fact that when output falls so dramatically, governments do tend to run large deficits because the so-called automatic stabilizers like unemployment insurance start operating. So that has quickly turned this crisis from a private sector problem to a public sector problem. That is, the public sector finances are now deeply in trouble across the world, not just in the United States. Of course, when you have a public sector fiscal deficit which is large, public debt which is large, you quite quickly come to political problems, which is how are we going to tax to pay for the enormous debts that we've built up? Who is going to pay these taxes? And are there more obvious culprits that we can point to while we're trying to deal with the underlying problems of this country? And typically, when you're trying to look for scapegoats outside the country who don't vote often are far more subject to blame than domestic scapegoats. And so amongst the consequences of this crisis, the fallout from dealing with the crisis that we should expect to see is more political conflict about how this crisis gets paid for, who bears the brunt of taxation, and how that evolves over time. You already see it playing out in the US Congress over the last few months. A second aspect that we should expect to see is trade, that we're already seeing noises made about the Chinese currency, with the US at 10% unemployment and China growing at 10%, at least for the moment. Clearly, the language is going to get more heated over the course of this year. I haven't pointed to yet another consequence of crises, of deep crises, which is the conversation or the conflict over trade sometimes spills over into actual physical conflict. That certainly was how the Great Depression ended. It's not necessary that it end that way, but that is a potential outcome of deep conflict. So to the question of, is it over yet? No, the consequences are still bubbling through the system. The immediate crisis to the financial system is largely over for the big banks, still developing for the small and medium-sized banks across the world. Some parts of the world, they still have to recognize the costs, the losses that they made, but it's moved beyond the financial sector now to the government sector, and beyond the government sector to the political sector. And so there will be consequences over time. But I also want to argue that if we refer to it as this narrow crisis itself, it's actually, to my mind, a sequence of crises, starting with the emerging market crises in the 1990s, evolving into the dot-com bust, and then moving into this crisis, but the underlying forces are still unresolved, and I want to come to that next. So, if you focus on this particular crisis itself, what are the popular explanations? The immediate explanations is we had a bunch of greedy bankers who went in over their heads, and we had a bunch of ideological regulators who basically said, laissez-faire, let's stay away, let's not do anything to interrupt this process, and as a result, the system collapsed. Now, that's an easy explanation, and it's an explanation that's politically easy to sell, but there are many questions with that kind of explanation, right? The first question, of course, is why now? Why did it happen at this time rather than earlier? After all, bankers have been greedy since the dawn of time. Why did the bankers get excessively greedy at this point and create the problems? And of course, there's the additional point that regulators and the whole system of checks and balances, the politicians who oversee the regulators, all that to some extent is endogenous. It's part of the system. And so you can't suddenly assume that these guys became ideological. Why did they become ideological at this time? What was it that made them take their hands off the financial system and say, go for it? More generally, when we think of a sophisticated country versus the standard emerging market, we typically define a sophisticated country, a developed country, as one which has lots of institutional checks and balances, right? Which has somehow curbed the natural instinct for corruption, for excess in the system. A developing country is a country which still is figuring out how to do that. An industrial country has figured that out. So what happened to the checks and balances in the United States? Why did the United States become an emerging market and suffer a typical emerging market crisis? To my mind, that is one of the important questions we have to answer. Second important question we have to answer is, typically when you have excess happens through much of the economy, and typically, often it happens, especially when you look at housing, in the upper segments of housing. If you look at past US real estate booms, it typically occurs with the rich segment. The rich segment moves up the most, comes down the most. This time it happened with the poorer segments, with subprime. Why was so much of the action centered around subprime housing, the poorest of the housing segment? Why did it happen there? Again, that's something we need to talk about. So I want to split my explanation into two parts. One is a macro-political explanation, which talks about how we got these circumstances, both macro and political, which created the conditions for the financial sector to run amok. And then I want to move to a financial sector part of it, which says, given these political circumstances, given the macro circumstances, why, in fact, did the problems emerge in the financial sector in the way they did? So it's a two-part explanation. Let me quickly explain what the first part is, give you an overview, go to the second part, and then detail each of these explanations. I want to tie what happened now, but also what happened to the emerging markets and what happened in the dot-com boom to a lesser extent, to the path of growth countries followed post-World War II. And one of the things that is extremely important to understand is the growth paths that were followed post-World War II were quite different from the growth paths that industrial countries that became rich followed in the 19th century or even in the early 20th century. 19th century growth was relatively slow growth, was steady growth, but slow growth. Per capita growth rates, for example, for these fastest growing emerging markets of that time, the Australias and the United States of the world, were 1.5 to 2% per year. But they did that year after year for a long time and therefore became very rich. Post-World War II, the kinds of growth paths we had were extremely fast growth paths. I mean, the classic example is Japan, which grew at 8% per year between around 1950 and 1973. But other countries have come close to replicating that. I'm talking about per capita income growth. Other countries like China have certainly come close. And these growth paths were not the balanced or relatively balanced growth paths that other countries followed. They were particularly focused on exports, and I'll explain why. And initially, for countries like Japan and Germany, they focused on exporting for growth, but they also invested tremendous amounts and imported a lot to make those investments. So it was relatively balanced, but as we got into the 60s and the 70s and these countries became relatively rich, investment started falling off, but the export sector was still exporting a lot. So these countries, as you move into the 1980s, start pumping out big surpluses. Now, when you have two of the biggest economies in the world pumping out big surpluses, somebody actually has to absorb them. And in the 80s and the 90s, it was the emerging markets of the world. And let me focus on East Asia, but certainly there were countries in Latin America, India, which absorbed these surpluses. In East Asia, in the 1990s, the surpluses were in part absorbed by increasing the level of investment. So investment, for example, in Malaysia, Korea, and Thailand went from about 25% of GDP to about 42% of GDP. Enormous increase over the span of that decade before 1997 in investment, financed by borrowing from abroad. And clearly, when there are surpluses generated in some part of the world, the financing is available for countries that want to absorb those surpluses and run deficits. However, that foreign financing proved unsustainable, and I'll talk about why that proved unsustainable. Unlike the financing of Japan and Germany when they grew, there was a big difference because this was private financing rather than government financing. A lot of the financing for Germany and Japan, Germany, for example, in the early stages with Marshall Plan lending and so on, now it was private finance, especially financial markets and foreign banks, and that proved unsustainable. You had a boom and bust in the 1990s. Emerging market after emerging market went down. And a lot of these countries decided that borrowing to finance growth was a bad idea. And many countries started restructuring government finances, restructuring public finances. Even the corporations restructured investment. And they cut back, certainly in East Asia, tremendously on investment. They started cutting their coat to fit the investment cloth, or cutting their investment to fit the resource cloth, and essentially started moving away from absorbing surpluses, running large deficits, to actually running large surpluses of their own. Okay? So you had the old surplus countries, the Germanys and the Japans, Germany temporarily running deficits in the 90s because of the integration with East Germany, but again starting to pump out surpluses in 2000, coupled with the emerging markets who found that they couldn't absorb other people's exports, and they started pumping out exports of their own. So large surpluses moving into the world economy, who increases demand to absorb these surpluses, to start buying more than they produce. And there was an interval in which industrial country corporations increased their investment. That didn't end well. That ended in the dot-com bust. And so we come to 2000, 2001. Industrial country corporations are played out, can't increase their investment. They have overinvested. Who's going to take up the slack to spend to absorb the surpluses that are being pumped out elsewhere? And at this point, a bunch of countries oblige. The United States, the UK, Spain, these are the countries that start running large current account deficits, large trade deficits. And the question is, why did these countries step up? And I want to argue there was something peculiar in these countries at that time. Specifically, I'm going to focus on the US. There was something particular about the US which made it willing to actually expand, like the typical emerging market. And I want to focus on that in what follows for a little while. The circumstances I will allude to are largely political, and those political circumstances, in many ways, created the underlying broad circumstances for the crisis. Now, it takes two hands to clap. One hand came from these macro political forces which caused the US to run large deficits, to draw in a whole lot of foreign financing. The other hand that participated in the clapping was obviously the domestic financial sector, which is where I have the second part of my explanation. The kinds of actions that the public sector took at that time, and I'll come to them in greater detail, had two effects. One, it coordinated the private financial sector into taking certain actions. And I want to focus on those actions which I think are central to this crisis. And the second aspect of that is, once the private financial sector was coordinated into taking some of these actions, they understood that if these actions had adverse consequences, because so many of them had been coordinated into taking these actions, the government would come in and help the private sector out. So as a result, the incentive to maintain precautions against the potential downside of the actions the private financial sector was taking, the banks were taking, the investment banks were taking, their incentive to stay away from the downside decreased because of the potential coordination and the anticipation. And as a result, the probability of the crisis increased and eventually actually happened. And the point I want to make is the left, when pointing to this crisis, says it was all the bloody-minded actions of the financial sector. These bankers hankering after bonuses went out and did crazy things. I want to argue that that was not all there was to it. There was a hand of the government which played an important part in creating the structures which allowed the private sector to take the risks that it did in the areas that it did. And this is where the subprime issue becomes very important. So I want to argue the private sector took advantage of government interests in furthering certain processes. At the same time, the problem is not wholly a public sector problem also. The private sector did do certain things which went overboard. So it's a combination of those two. The government undertaking certain actions because of the macro political factors, and the private sector taking some actions because the government took those actions. Those two came together. So you can't blame just one side here. It is collective blame, and therefore the actions you have to take to resolve this kind of problem have to be collective. So that's where I'm going. Now let me get to details and bring this down to ground level. So I think the problem, in some ways, lies with the path of growth that countries followed. So what are these two pictures? Just pop quiz, which city are these pictures of? One is the city right after World War II. The second is the city today. Okay, no answers. This is Seoul, Korea. And you can see pretty much a third world economy in the picture on the left, and you see a first world economy, the picture on the right. This is in the span, really from about early 1960 to 1990, 30 years, 3 decades, half a lifetime or even 1/3 of a lifetime for many people. That's the transformation. Never before in history have countries transformed so fast. And the question is, how did they do it? And I will argue they did it in ways that created certain benefits in the short run, but in the long run created certain distortions. My sense is many of these countries, and here I'm entering controversial territory, the exact factors that lead to economic growth are still a matter of great debate. But one of the things that these countries did right, or seem to have got right, is there was a substantial amount of government intervention which focused on creating strong firms, often by creating a producer bias, giving subsidies to firms, subsidies in terms of lending, subsidies in terms of raw materials, and sometimes subsidies in terms of protecting them so that they got some profits, protecting them from foreign entry and competition. However, if you continued along that path, if you continued protecting your firms, where you ended up was in a rent-seeking economy of the kind that India had, an economy which grew very slowly, which was stuck in the Hindu rate of growth. The countries that got it right did one more thing. While they protected their firms, creating organizations which had the capability of growing, they also pushed them out to export. India had a large domestic economy, not much incentive to push countries to export. Countries like Korea, countries like Taiwan had a very small domestic economy. So on the one hand, they had really no option but to export, but also they had somewhat authoritarian governments which pushed them and didn't have to listen to the magic of the elections and election funding. They pushed them and got them to export. And so what these countries had was an export sector which was extremely efficient, extremely good, extremely strong, extremely competitive, right? On the one hand, they had that. On the other hand, because producers were hand in glove with the government, and because the ability to get that competition to work domestically was quite difficult, they had an inefficient domestic-oriented sector. What economists call the non-traded goods sector was extremely efficient. Just as an example, we have competition with, oh, that's a scooter, right? Okay. Even while they had an extremely efficient export-oriented sector, they had an extremely inefficient domestic sector. And here, the ability of the producers to go hand in glove with the government and determine regulations without any foreign competition limited the extent to which this sector could become efficient. One example is Japan. Many of you who've been to Japan notice that there still is this institution of the elevator lady. What is the elevator lady supposed to do? Well, she's supposed to direct you towards the nearest elevator which is there. Now, this is something which doesn't require genius. The light is flashing, there's a bell, you know which elevator is there. You don't need an elevator lady to tell you where to go, but yet that institution survives. This is an example of the kinds of inefficiencies that still survive. In Japan, haircuts, extremely expensive. Haircuts are the quintessential non-traded good, the good for which you can't compete across borders. In the US, I can't compete on giving haircuts in Japan because you need a physical presence there. Till such time as we invent machines that can work cross-border, not going to happen for some time. Haircuts are extremely expensive in Japan. Now, recently, a small firm started up saying, we're going to reduce the cost of haircuts. We're going to make cheap haircuts available in Japan. Well, they started expanding very fast because there's a huge demand for cheap haircuts. At which point, the Barber Guild sort of got anxious, persuaded their friends in the government to take action. And so within a few months, they passed a regulation saying, in order to have safe and clean haircuts, you first have to have a shampoo. In order to have shampoos, you have to have facilities, which means a big tub, a big wash basin, water, and the whole lot of paraphernalia. Within a few months, essentially, they made it impossible for that upstart to compete because that upstart had to make enormous amount of new investments so as to give the shampoo and the and do the right things according to the regulations. What I'm trying to argue here is, while these countries have extremely efficient foreign-oriented manufacturing sectors, they have extremely inefficient domestic-oriented sectors, largely cartelized without competition. One example of this is, if I ask you, name 4 Japanese manufacturing firms. You can reel them off. Toyota, Canon, Ricoh, Nissan. I mean, you can just reel them off. Let me ask you to name 3 Japanese fast food restaurants around the world. Chains. Harder. 3 Japanese hotels around the world. 3 Japanese banks. As soon as you move away from the domestic, from the foreign-oriented sector to the domestic sector, it becomes much harder to talk about examples of non-traded goods in Japan that work particularly well. Why am I talking about this? Well, I'm saying that as these countries followed the export growth path and became rich and stopped needing to import machinery and investments from from around the world, they started generating large surpluses. This did 2 things. One, it made them extremely dependent on exports for their growth. If there was a downturn in the world economy, they suffered enormously. If you look at 2008, the countries that suffered the worst in the world economy were not the United States or the UK, where sort of the epicenter of the crisis was, but countries like Japan, like Germany, which didn't have financial sector problems, but were so export dependent that their rates of growth plummeted. East Asia also. The second is when they want to pump up their economy, they don't have effective ways of doing that. So the world is in trouble. They want to pump up their own economy, don't have good ways of doing it. I mean, in Japan, because of the close nexus between the government and the construction sector, a lot of stimulus often is new projects. Well, over the 15 years or 15 to 20 years that Japan has been in crisis since the early 1990s, much of Japan is now covered in concrete because every stimulus program is yet another building project here, there, everywhere. But it hasn't lifted Japan out of its doldrums because much of that expenditure is very inefficient and doesn't really produce, is not effective. So what do we have? I think Japan is the archetypical example of a country that focused on export-led growth and now has become extremely dependent on exporting in order to grow, cannot move away to a more balanced economy now because it has a domestic-oriented sector which is highly paid, extremely inefficient, and when you get the combination of people who have high pay but are inefficient, change is extremely difficult. Because if you needed to change, in order to get them to be paid according to their level of inefficiency, you would have to reduce their wages tremendously. Not going to happen so long as they have political power. So it is stuck in paralysis and can't move. Germany, to some extent, is similar but not as bad, partly because Germany has the discipline of the euro area, preventing it from the kinds of policies that have engulfed Japan over the years. The euro area, the European community, has helped increase the level of competition in Germany over and above what it would have been if it had been on its own. The big worry now for the world is China. Is China going to go along the Japanese path so that it focuses on exports till too late, till it can't pull back? It's still early days for China, but that's a possibility. So we get these surpluses being generated by these countries because of their way of growth. And then we have these emerging markets, which are starting along that path of export-led growth, but are still importing a lot in order to make the investments. They are still running large deficits. They're running larger deficits in the 1990s. I will put aside right now the Indias and the Brazils of the world. Those were more consumption-led deficits. These were investment-led deficits in East Asia. But a lot of this investment in Asia was financed with foreign capital. And the foreign capital came in the traditional way foreign capital comes in. It basically said, you need to finance stuff. We will help you finance it, but we want guarantees. We want guarantees that you won't dispossess us of our money. And often in these situations, the guarantees come in ways that are extremely difficult for the economy. In the case of East Asia, the banking system was supported by the government. And so the idea was, if ever the banks refused to repay, there would be a chance that they would go under. The government would come and support them. And that would uphold the value of the foreign investors who had invested in these countries, right? Does that sound familiar? You have foreign investors putting their money into an entity. That entity is supported by the government. That means the crisis, when it actually happens, the taxpayer will come and repay the foreign entities. Think about AIG. Think about who AIG had written claims to. It had written claims in many situations to foreign entities. It was being supported by the government. The foreign entities came out whole. Think about Fannie and Freddie. Fannie and Freddie had written a whole lot of debt claims held by the foreign investors, often foreign governments or foreign quasi-government entities, again supported by the government eventually. So the point I'm trying to make is there's something about foreign lending, especially private foreign lending, which often looks for government backing. And in these cases, the government had effectively given their backing by supporting the banking system and created problems so that when the foreign investors took fright, essentially the government had to come out and bail out the system. Enormous crisis engulfed these countries. They had to go and borrow from the IMF. They had to subject themselves to IMF conditionality. IMF conditionality was extremely harsh. And essentially, a number of these emerging markets basically said, never again. Never again are we going to borrow from foreign capital because it's just too dangerous. It comes in and it leaves abruptly. When it leaves, we have to make it whole. Because we have to make it whole, our country suffers. We're not going to do this again. And so many of them moved towards intervening in their currency, keeping it relatively low, making the export sector even more competitive, and building up large reserve holdings. They reduced the investment or consumption, and essentially they added to the problem, which was already growing because of the surpluses from Germany and Japan. This was now augmented by the surpluses from the emerging markets. Okay? So the fault line here was the inadequacy of cross-border finance. And this is a picture which gives you a sense of how big this effect was, that you see that Korea and Malaysia were running deficits which are sizable. I mean, if you look at the Malaysian deficit touching near 10% of GDP in the 1990s, 1996 is the last year it's negative, shoots up to a huge positive surplus. Malaysia now is running a current account surplus of 17% of GDP. In other words, it produces effectively 17% more than it consumes or invests. And that stuff is being shipped out into the world economy. Okay, so these surpluses went looking for entities to spend. I'll pass over the dot-com boom, which was a temporary episode. And then I'll come to the United States in 2001. Corporations aren't willing to spend. Who's going to spend? Who's going to up their spending to absorb these goods which are being pumped out in the global economy? Now, I'm sort of caricaturing the process. It's more complicated than what I'm saying. But fundamentally, it boils down to this. Guys are producing a lot, pushing it out in the global economy. Somebody has to spend. And in the United States, the spending came from households. They increased their spending. They also increased their investment in houses. So housing investment went up, and spending by the households went up. A lot of this came from the poorer segments in the US economy, subprime households and so on. Now, this was facilitated by extremely accommodative monetary and fiscal policies. And what I want to talk about is two things. One, why subprime? Why wasn't it the normal housing boom and bust? And second, what role did monetary policy play, and why did it play that role? Why was monetary policy so accommodative? Didn't Alan Greenspan realize what he was doing? I want to talk about these two things. So first, subprime. What was subprime the answer to? Why did we get so much government push towards subprime housing? And I want to argue that in the United States, over the last 25, 30 years, we've had growing inequality. If you look at the wages of the 90th percentile earner, they went from about 3 times the wages of the 10th percentile to about 5 times. So they've grown. Now, most of you hear or read the newspaper stories about guys at the 0.01% level, the hedge fund managers in Connecticut, how many thousands of times in average workers' wage they're making. That's one part of the story, but I think the more interesting and worrisome part of the story is how the office manager is now making so much more than the median worker than they used to in the past. The question is, why is this happening? And if you look at the studies on this, many of them focus on education. That what is happening is that the US is losing the race between education and technology. What do I mean by that? I mean that typically technological progress proceeds apace and requires people with higher and higher education to work. In the early part of the 20th century, what you needed was no longer some years of schooling, you needed a high school education to work in the chemical plants and the factories that were being built. As we move into the 70s and the 80s, high school education is no longer sufficient. You need a college education, an undergrad degree. And as we're moving away into the 2010s, it's no longer just an undergrad education. You need a a secondary degree at this point. So the demands for education are increasing. What the US has been unable to do is keep up with the supply. And in many situations, it's not because we don't have good universities here, it's because the quality of education imparted at the school level has been falling behind. Okay? So for example, high school graduation rates haven't increased since the 1970s, which is an alarming fact. And second, if you look at college completion rates, they're not different for males born in the 1940s from the graduation completion rates for males born in the 1970s. Even while the demand has increased, the supply has been relatively stagnant as far as males go. The story is much better for women. It's much stronger. And we can delve, and I'm not going to delve at this point into why this is the case. A lot of it has to do with K-12 experience and preschool preparation. But the point is, many Americans are being left behind in perception, if not in fact. And this has been increasing polarization, increasing difficulties at the political level. Now, the ideal thing would be to fix the problem directly, fix education. But if education is difficult to tackle, what do you do? Well, if you're a politician, one of the things you can do if you're worried about this constituency is redistribution. But there has been limited support for redistribution, and there are huge costs of doing it in terms of incentives and so on. Well, you think about what people want. People want consumption. They don't care as much about incomes if they have consumption. And so one way to create that consumption is through credit growth. And in fact, whether by design or by happenstance, what has happened is housing has been the source of the credit which has kept consumption relatively strong, especially for the poorest households, even at the expense of increasing their debt levels substantially. Moreover, housing has the additional benefit of giving households that are falling behind a stake in the future. If you see your savings are not growing, your income is not growing, but your house price is growing, well, that's an asset that you have. You feel more comfortable. And so in many ways, I argue that home ownership was pushed as the answer to a number of problems stemming from rising income inequality and income not growing. It was a bipartisan effort. The affordable housing push by Clinton, which resulted in Congress setting norms for Fannie and Freddie to lend to lower income segments, or the ownership society push by Bush, which resulted in some of those mandated requirements for lending by Fannie and Freddie to actually be increased during George W. Bush's time. Why did the US go further than this than other countries? Well, the US had the instruments that could be put to work. Somewhat paradoxically, these were the instruments that the US used to bring the United States out of the mess that was created during the Depression. These were instruments like the Federal Housing Authority, like Fannie Mae, which was created around the time of the Depression, and Freddie Mac, which was created more recently. These were the instruments the US used to push housing at low-income segments. In many ways, this was a classic emerging market response to inequality. A populist move. Typically in emerging markets, households can't borrow, so it's the government that borrows and has populist programs. In the US, the private sector was the intermediary through government organizations like Fannie, Freddie, the FHA, and the Community Reinvestment Act. So the point I'm trying to argue is, why was the US in the forefront of pushing consumption? In part, it was the political forces within the US, which is rising levels of inequality, strong political pressure to do something. The way to do something that would have been right was improve education. Hard to deal with education in the short run, very difficult to change it. Easier way is to expand credit. Populist credit expansions, time and again, are the way that emerging markets have dealt with the problem. this is where the US became an emerging market. It pushed credit expansion as a solution. In addition, though, this was just part of what was going on. In addition, there was substantial stimulus which led to the problem in 2001. And why was there such enormous stimulus in the United States? And I want to argue that in addition to the underlying inequality which creates problems, the US also has a low threshold for pain in downturns. And that's because of the nature of the US system. And what's been happening in the US system over the last few recoveries is that the pain has increased. Let me explain. US recoveries used to be very fast. You go down and you come back very quickly. Typically, it took 2 quarters for growth to recover from the trough of the recession. It took 8 months to recover all the lost jobs. So in post-war recessions and recoveries, the US went down, came back up. So in these circumstances, you didn't need a very strong safety net. 6 months insurance, which is the norm in the United States, was enough. People lost their jobs, they got unemployment insurance, but they had a very strong incentive to look for jobs because jobs would be coming back, and they actually got those jobs. What's been happening since 1991 is the pattern of recoveries has changed. In 1991, it took 3 quarters for output to come back. It took 23 months, that is almost 8 quarters, 2 years, for jobs to come back, way beyond the time that unemployment insurance runs out. In 2001, it took 1 quarter for output to come back. It was a sharp V-shaped recovery in terms of output. But it took 38 months, that is close to 3 years, 3.5 years, for jobs to come back. So in that kind of environment, when it takes really long for jobs to come back, where unemployment is really long-term, the pressure on the politicians to actually stimulate the economy till the jobs come back is enormous. So in 2001, you had a fiscal stimulus, which was large. But you also had a monetary stimulus, and I want to focus on this. People say the Fed was on hold for too long. Well, too long relative to what? They look at output growth and they said, well, output growth came back. The Fed should have been raising interest rates pretty quickly after output growth started coming back. But that was not what was driving Fed policy. What the Fed was looking at was the unemployment rate. And the unemployment rate was not budging. It took much longer for unemployment to start falling and jobs to come back. And so the Fed was on hold for a relatively long time. So the point I'm trying to make here is because of the thin nature of the safety net, and because recoveries have certainly become much more long drawn out in terms of job recovery, the pressure to stimulate till the jobs come home is enormous, which typically means Fed policy is on hold. And to the extent that Fed policy keeps interest rates at a very low level for a long time, it creates a whole set of incentives in the private financial sector, which I'll come to in a second. But the last aspect I want to add here is that it was not just low interest rates at that point. In order to push job creation, the Fed also made commitments about being willing to infuse the economy with liquidity if the economy got into trouble. This was the famous Greenspan put. And he said, look, we're trying to help the economy. If the economy gets into trouble, we'll try and infuse enough liquidity so as to make sure the economy comes out of it again. If there was ever an excuse, the financial sector needed to go haywire, to just go stretch out on a limb and take risks, the Greenspan put was certainly one part of it. So what I want to argue then here is that what we have is jobless recoveries in the US overlaid on the inequality, and both these tend to combine to create, one, directed credit into housing, two, very stimulative policies, both of which tend to have an effect on the financial sector. So let me come to the last part of what I want to argue about. What does all this have to do with the crisis? Well, we had a whole lot of low-quality mortgage-backed securities created, right? Why were these created? What role did the government play? Well, clearly the enormous amount of money flooding into this sector from government sources, from foreign sources, money that didn't ask the same kinds of questions that the private sector would have asked, did play a role in making it easier to sell these kinds of securities, and a lot of them were in fact sold. So I want to argue that's part of what happened. But the critical question we need to ask is why banks held on to much of this risk. And I want to argue banks held on to much of this risk because, again, the kinds of messages that was being sent out by the monetary and fiscal authorities was, if you get into trouble, we will come to help you. And in fact, that's what we've seen happen. And so the private financial sector was in many ways incentivized to do the kinds of things they did. Not blameless. They bear a big part of the responsibility, but it was part of the incentive structure. And let me end by making those 2 points. One, why mortgage-backed securities? Well, a wall of money was pouring into subprime lending. There's a gentleman, Peter Wallison, at the American Enterprise Institute, who's made a study of this and has actually tapped into sources from somebody who was at Fannie and described the extent of lending that went on from these organizations into the subprime market. Now, this is a market that was really non-existent in many ways. It was quite tiny until the huge amount of money started pouring into this market. Well, when you have a whole lot of money pouring in, it tends to distort prices. It tends to distort behavior also. Why do the rating agencies go berserk? Because there's a tremendous appetite for the kinds of securities that were being issued by that were being rated by the rating agencies. Tremendous appetite, which certainly in the short run made it convenient for them to forget about the details of rating carefully and made them a little more hospitable to what the issuer wanted. Now, were they doing the right thing? Of course not. But they were incentivized in part by the wall of money that came in. Part of that wall of money came in from government mandates. Part of it came in from foreign money, which was looking for high-yielding safe securities. Together, I think they helped reduce the checks and balances that were there on quality. And one story I like to tell is that when banks held on to this stuff, when banks held on to low-quality mortgages on the balance sheet, they did a really good job on doing due diligence and trying to find out the quality of the borrower. This is why banks didn't go haywire in the early 1990s or the mid-1990s. But as it became possible to sell this stuff on towards less discriminating foreign investors, to Fannie and Freddie, who had a mandate to lend to these kinds of sectors, the kinds of checks and balances that the banks followed became weaker and weaker. In fact, as they knew they could securitize, and as they knew the person on the other side buying these securities had only limited ways of checking what was in them, they focused more on the stuff that they could check. For example, investors in these mortgage-backed securities could check the rating, the credit rating of the homeowners who held the underlying mortgage. So over time, what the banks decided was, I need a good householder with an adequate credit rating. I don't care what else happens. All I want is the credit rating to be right. Well, once the mortgage broker knows that all the bank is interested is the credit rating of the homeowner, he works to massage that credit rating such that that credit rating meets the bank's norms. And there was a lot of this massaging going on. So even while the credit ratings of the homeowners who had borrowed remained relatively high over time, the underlying quality was deteriorating. Why did all this happen? Because at the end of the line, there was somebody willing to buy the stuff without asking too many questions. There's a huge wall of money pouring in. And so to some extent, the wall of money does play a role in determining what actually happened. But the banks who were issuing this stuff ended up holding a whole lot of stuff on their balance sheet. Why did the banks hold this stuff? Didn't they know what was in it? And we have to recognize that it wasn't clear throughout this process that we would have a crisis of the order that we had. What happened was the incentives to maintain risk controls, to manage the risk, were weakened by the process that were going on. Banks, in many ways, were taking a bet. And the bet that they were taking, given the nature of the financial system, is the best way to explain that is by talking about earthquake insurance, right? Now, in the financial sector, in the modern financial sector, when you write risks, when you take on risks, investors are looking to see whether you make a return over and above the risk that you're taking on, okay? In finance, this is known as creating alpha. Put differently, if you hire a money manager to manage money for you, if all they do is invest in S&P 500 securities, it is clear that that process of investing is extremely easy. It is a process that you yourself can follow without hiring a money manager. Why would you hire a money manager to go out and invest in S&P 500 securities? You could do it on your own. What you're paying for is they invest in large companies and do it in such a clever way that they produce additional returns. Well, managers find it very hard to produce additional returns because it's just very hard to beat the market. Well, one way you can beat the market is by disguising the risk that you're taking. And this is where the analogy of earthquake insurance comes in. If I am writing earthquake insurance, but I don't tell you I'm writing earthquake insurance, and I collect the premium from all my customers who are paying me to write earthquake insurance for them, I'm making a lot of money a lot of the time. I look like a genius because I'm showing no risk. But of course, when the earthquake hits, right, I have to make a lot of payout. But if by that time I've taken all this money that I've made, paid myself huge bonuses, paid my shareholders dividends, all I have is a shell of a company, right? Better still if that shell of the company is bailed out by the government, because then the taxpayer bears the cost of all the wonderful things I've done. Well, in many ways, this is what the financial sector was doing. It was trying to portray that it was creating risk-adjusted returns, but actually it was writing various forms of earthquake insurance, risks that would be extremely costly when they hit, but had relatively low probability, and while the going was good, they took the premium and paid it out themselves, paid it out as dividends. And in some ways, the government helped them do it. How did it help them do it? Well, you know, when the government says, if there's a liquidity problem, I'm going to help you out. I'm going to come in and flood the market with liquidity. Then I have an incentive to take the kinds of investments which will suffer when there's a collapse of liquidity, because at that point I know the government is going to come in. Even better if everybody's doing it, because I know for certain the government is going to come in and support the markets. So at one level, what the banks were doing was essentially rolling the dice, taking big liquidity pays, investing in mortgage-backed securities, which 95, 99% of the time would work out well, but with small probability would be a disaster, right? And they were financing it with huge loads of debt. Again, you could easily roll over the debt most of the time when times are good. With small probability, financing would drive up. But you know, under those circumstances, you were toast. You know, why do I care about those circumstances when I'm toast, especially if the government is going to bail me out? I'm going to take these risks. I'm going to take these risks in spades. And there is evidence that this is what was happening. When you look at the companies that took the most risks, these were the companies that were rewarded with the highest stock prices in the 1990s. They were the ones which had the highest stock returns. They were the ones that, before the crisis in 2006, had the highest stock prices. The market was rewarding this kind of behavior because it knew that on the upside, the shareholders and investors benefited. On the downside, the government took the hit. And ex post, what we've seen is exactly this happen, right? Yes, there were a few unfortunate institutions. Lehman went down. You know, Bear Stearns barely got anything. But if you look at the crisis being a small probability event, it made sense for all these entities to go out on the limb and take these risks, because when push came to shove, the government came in, bailed out the banks with direct intervention, bailed out through liquidity, and is actively intervening in the housing market. The entire housing market currently is being supported by various government programs, right? So the bottom line in this that I'm coming to is essentially macro forces create a set of circumstances where the government pushes housing, wants to push activity, creates support systems which encourage the financial sector to take certain kinds of risks. Eventually, when the risks emerge, the government comes in and bails out the financial sector, right? And the problem is, now that we've done it once in a big way, what's to prevent us from doing it again? What's to prevent the financial sector from taking these kinds of risks, knowing that the government cannot, in fact, resist coming in to support the system? Especially if the political environment in the United States gets more and more, gets weaker and weaker over time. So basically, how do we prevent it from happening again? And my sense is certainly you have to have financial sector reforms, but also I think you have to have real sector reforms so that the government, in a sense, is not taken advantage of by the financial sector. The government can actually do the things it needs to do. For example, education reform. For example, we have to debate whether the safety net has to be made stronger, given the fact that recoveries are much more drawn out. We have to understand why they're more drawn out, and there's some theories on that. But if they are here to stay, does the United States require a stronger safety net so that the brunt is taken by the safety net rather than by policies that are in some ways encouraging the kind of risk-taking that actually took place? Should it be the safety net rather than monetary policy that tries to bring that puts some kind of floor on what happens in recession? So let me, given that we are running out of time, let me end with this last point. Clearly, in the financial sector, we need reforms. The reforms, to my mind, have to focus not on equity, it has to focus on making sure that investors absorb the downside risks that they are creating, that they're allowing the banks to create. And more than anything else, this means that debt holders, when there's a calamity of the kind that we've seen, bear some of the costs of that calamity, bear some of the costs of the downside, bear the hit, and therefore focusing on them absorbing the hit, that has to be central to our policies. Trying to get equity, people say it was a lack of governance. What I'm trying to argue that if you were governing the bank in the interest of your shareholders, you would take these bets. Because most of the time you would make a ton of money. In fact, that's what the stock lagged. While the Citibanks of the world who took all these risks, their stock price zoomed. The market was cheering you on because these kinds of risks made sense for the shareholder. So you can't rely on the shareholder to control management, to keep these risks under control. You have to rely on the downside. One important source of downside would be if it hit the debt holders, they would keep the bank from getting too big. For the US, we need the US to have more effective policies, especially for downturns. I think structurally there is an issue about the growing inequality, and can we resolve the growing inequality by improving access to education, for example, rather than focusing on redistribution? That debate is alive in the US today. If we go down the path of redistribution, to my mind, that will remove some of the flair and innovation that exists in the US economy. We need to go down the path of improving access to making sure more of the citizenry get access to good, sound education. How do we do that? How do we keep people happy while that's happening? That's, I think, the central question the United States has to face. And I think the healthcare debate sort of feeds into that. Second, as far as downturns go, how do we preserve the flexibility and the innovation that is in the US economy as a result of being able to hire and fire relatively quickly, even while recognizing the nature of the recession has changed, and maybe the safety net needs to be a stronger and more long drawn-out safety net. This, to my mind, are the central political questions the US has to answer, and we will answer them in some fashion over the next few years. But if we don't answer them and we leave these questions untackled, US policy is going to be relatively inadequate for the needs of the moment. And US policy, of course, is a reaction to another factor which is outside the US's control, which is the behavior of countries outside the US, the surplus countries. Japan and Germany now China increasingly joining that. How do you deal with these surplus countries and get them to see that more balanced growth is in the world's interest, that the US cannot continue to be the consumer of last resort, they cannot continue to rely on bad US policy, which results in the kinds of downturns that we've seen, the kind of crisis that we've seen, to hold their growth up. How do we get them to play a bigger part in contributing to world growth? That, to my mind, is the central question facing global governance. It's a question that there are no easy answers to, and let me end at that point.